Assalamu alaikum everyone. How are you? Good morning. Uh, our today's lecture is related to the grouping of ratios. This is the slide where we ended the last lecture. Unfortunately, last week we cannot conduct it. We could not conduct classes because there was some interruption of internet as well as there was a load shedding issue. So uh, now we are continuing from the continuing the topic actually which we were discussing in our last lecture. Um, in the last lecture, we started our discussion with the characteristics of the financial ratios. We have discussed what are the benefits of the financial ratios, what actually the financial ratios are, and then we have also discussed the limitations of the financial ratios, and we ended our lecture on this slide where we were discussing that on the basis of characteristics we can divide financial ratios into profitability ratios, efficiency ratios, activity ratios. uh, Financing or activity means same. Financing ratios, cash flow ratios, and investment ratios. Uh, Financing ratios can be further divided into liquidity ratios and solvency ratios. Um, well, as we have discussed, that profitability ratio is basically related to the performance of the company. We have discussed that there can be two aspects of the financial health of a company. One is performance, and other is position. Financial performance and financial position. Financial performance refers to the overall the result of overall activity of a particular company during a particular accounting period. Okay. For instance, our the result of our business activity is gauged in profit. Okay, so profit is one of the indicator or one of the gauge to know that are we successful in our objective, and what are the results of our business activity in form of profit or in the shape of profit. Okay. Similarly, efficiency or activity ratio is also an indicator of the performance, whereas financing ratios is basically the indicator of financial position. Financial position means where we stand in terms of our resources and in terms of our liability at a particular point of time. Performance can only be gauged of a period. It is not Performance can only be gauged of a period. I mean to say that you cannot calculate performance at a particular point of time. It is related to the period of time. Let's suppose uh, for an individual, the financial performance can be his income. Okay, so income cannot be at a particular date. It is related to a particular period. For instance, your salary of the month or your income of whole quarter or annual income. So you cannot say that as on today what is your income. No, you can't say that. You have to give a particular time frame in the form of time period. For instance, you can ask someone that in a week how much can you earn or how much have you earned. Okay, in a month how much have you earned, in an year how much have you earned. So as far as performance is concerned, it is always related to a particular time period. But on the other hand, financial position is basically related to um, at a is basically related to at a particular point of time. Uh, I mean to say that you can ask your client or someone that currently, right now, how much money do you have? This is his financial position. Or you can ask someone that how much assets you have, how much liabilities you have, but at a particular point of time. That's why when we were discussing financial statements, we have also discussed this point that few of the financial statements gives you financial position, whereas some financial statements provides a picture of the financial performance. So those financial statements which gives you financial performance on in their heading, it is written that for the period of dash 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 2008 to 2012 2015 2018 2020 whatever. So but for those financial statements which provides you financial performance on their heading. It is written that as on that like in a statement of financial position or balance sheet statement. It is written that as on 2020, as on December 31st, 2019. So this is at a particular date, at a particular time. Similarly, financial positions which we calculate is giving you the figures which we use in that ratios is basically provide us information in a sense that at a particular point of time where we stand. There are two aspects of financing ratios. One is called liquidity ratio, and other is called solvency ratio. Liquidity, in general terms, provide us the position of a company that how much current asset is with current liability a company has, or what is the ability of a company to pay off its short-term debt. Okay, it is if there is a liquidity issue, it means that there is a mismatch of current assets and current liability. On the other hand, solvency is rather uh, problematic, more problematic issue. Insolvency can lead to a bankruptcy, and insolvency means that you don't have enough funds to pay off your liability. Okay, or it is an ability of a company to pay its long-term debt. As far as cash flow ratios are concerned, all other categories of the ratios or groups of the ratios are basically based on accrual concept. But on the other hand, cash flow ratio is basically provides you the cash position, the performance of the on the basis of the cash based accounting, performance of a company on the basis of cash based accounting. Okay. uh, Similarly, investment ratios uh, are also very important, and especially from the viewpoint of investor, they are very important. Although this we are discussing this subject from the viewpoint of external user. Okay, so we are discussing this subject from the viewpoint of external user. All these ratios will be discussed, and we have already discussed in our campus classes that we are just like external user of a company, of the financial statements of the company. Means that we don't have enough access to the company to demand tailor-made information, but we have to rely on the journal purpose accounting financial statements. Okay, so being an external user, the most important ratio for us or is investment ratio, because In external user, the most important user is investor, and investment ratios are uh, giving us information about the investment opportunities in a company. It is also very important for the creditor as well, but for the investors, these are the most important ratios, or this set of ratios is most important. Now, moving to the next slide, we will discuss some of the important aspects of each category of the ratio. For instance, profitability. Okay, so profitability is the core objective of the business. Okay, in profitability ratios, our basic task is to perform cost benefit analysis. Okay, we create relationship between the profit level and the revenue means sales profit levels. We have different profit levels. We have usually have four profit levels. Number one is the gross profit, okay, which comes just after deducting the cost of goods sold from the sales. Okay, this is the first level of profit. Okay, at this level, basically we have just deducted the indispensable cost from the sales. Indispensable means that a cost which is necessary to generate, which is ultimately necessary to generate sales, okay, or to even conduct sales activity. Now, what are those types of cost which is very indispensable? Obviously, it is the if you are a manufacturing concern, in that case, manufacturing cost or production cost comes under the uh, cost of goods sold. It includes direct material, direct labor, FOH. These are the sort of costs which are very necessary to bring your goods into sellable position. Okay, so this is, we can say that these costs are indispensable. Okay, um, then uh, after deducting the indispensable cost, we reach to cost of goods sold. Cost of goods sold is are the indispensable cost, and we reach to gross profit. The first level of the profit is gross profit. After which, from this level, we deduct our overheads, but operating overheads. Uh, Operating overheads includes marketing expenses, admin expenses, utilities. Here, management has some, you can say, control, or they can increase or decrease according to the situation in the overheads. So, after deducting the operating overheads from gross profit, we reach to the second level of profitability, which is known as operating profit. Okay, the third level is after when we deduct operating overheads, and we reach to the operating profit. From operating profit, if we have taken some loan, or we have issued bonds, in that case, uh, we have to bear some financial cost in the form of interest. So when we deduct interest or financial cost from operating profit, uh, this is basically, we reach the third level, which is called uh, pre-tax profit. Okay, or it is also called operating profit, is also called earning before interest and tax. And this level, this pre-tax profit, is called earning before uh, earning before tax. Okay, uh, earning before tax. After calculating the earning before tax, the last level of the profitability is net profit. And in net profit, only one thing left which we deduct from it, and that is tax. After deducting the tax, we reach to the net profitability. Now, these are the four levels of the profitability: gross profit, operating profit, pre-tax profit, and net profit. Operating gross profit has some characteristics. Okay. Um Similarly, operating profit have some different characteristics. Pre-tax profit has its own significance, and net profit has its own significance. When we create relationship with these profitability levels with the uh, sales or revenue, we call them margins. Like gross profit, through gross profit we calculate gross margin by dividing the gross profit uh, uh, by taking gross profit into numerator and dividing it by sales. Similarly, operating profit or EBIT means earning before interest and tax will be divided by sales, and in that case, it will be called, this ratio will be called, this relationship will be called as operating margin. Then we have pre-tax margin, which we can calculate it, which we can calculate by dividing um, pre-tax profit by sales. And the last level of profitability is which is called net profit. So when we divide net profit by sales, we can calculate net margin. Okay, I hope you have get an idea about we have got an idea about this these margins. Okay. Then there are also another concept of return. Although we discuss these ratios under the category of investment ratios, but since it is related to the profitability, let's discuss some basic relationship of um some basic concept of returns. What is return? Return means that the rate uh, at which you are getting on your investment. What is return? The rate you are getting on your investment. Your investment can be represented by the assets, means return on asset, and your investment can also be represented by the equity. Okay, so return on asset and return on equity are the two ratios which are very important for an investor. uh, Return on asset gives you an indication of overall business return, whereas return on equity gives you a picture that what is the benefit for the shareholder, what is the net return to the shareholder. So we will be discussing these ratios in detail when we will discuss investment ratios. Okay, efficiency. What do we mean by efficiency? Okay, efficiency refers to the uh, operating performance. Okay, efficiency means that how quickly and how time how I mean to say that how efficiently, although I am using the derivative of efficiency, efficient means that you are using least resources to achieve some objective. When you are using least resources to achieve some objective, you will be called as efficient. For instance, you have usually listened or you have usually heard about fuel efficiency of a car of or a bike or even a generator. What does it mean? It means that is using less fuel and it gives you more output or more mileage That's why it is called fuel efficient. Okay. Then we have another example of efficiency, or another aspect of efficiency. When we are saying that a person or a machine which is using least resources, so we consider time as a resource as well. Okay, time is also a resource. So if you are performing your task on timely manner, again you will be called as efficient. Okay, so because time is resource, or you are taking less time to perform certain tasks, you will be called efficient. Okay, that machine will be called efficient. Okay, so efficiency of a company can be divided into short term and long term. Okay, long term efficiency gives us an idea about the overall efficiency of the company, or the efficiency of the fixed assets of the company, whereas short term efficiency is targeting to the current assets and the current liabilities of the company, efficiency of the current assets and the current liabilities of the company. These ratios, efficiency ratios, even you can perform the appraisal task of the department as well. You can know which department is efficient and which department is not efficient by calculating efficiency ratios. So these are very important ratios. We will be discussing how to calculate them, but usually these ratios are called as turnover ratios as well. Okay, turnover basically means revenue or sales, but when we take sales or revenue as as a not numerator, and we divide it by different ingredients of balance sheet, we calculate turnover ratios. And by calculating turnover ratios, we are basically calculating efficiency or activity ratios. Now coming to the financing ratios. These are again very important ratios. Financing, as you know, financing refers to the ability of a company to get, or it is related to the arrangement of fund. Okay, when we say financing, means arrangement of fund for a particular task of business. Okay, financing means what? Arrangement of funds for a particular task of a business. So when we arrange the fund, there can be different methods. Like you can arrange fund by taking loan, or you can arrange fund by issuing equity. Here we are. Here the financing ratios deals with the loan or debt which you issue or which you take. So when you take loan from a bank, obviously you have to repay, and you have to pay interest as well. So there are two obligations on you. One, when you take loan, you have to prepay the principal amount after certain time or in installments. And when you take loan, you have to pay a fixed charge on that loan, which is known as interest. So liquidity ratios give you a picture that how much capacity you have to repay your loan, and to pay to pay interest on those loans. Okay, uh, we not only the short term debt, but it also includes the portion of the long term assets, long term liabilities which you have to pay on short term basis. Because if you have taken a long term loan of 5 year, and each year you have to pay certain amount, so with the start of each year, that amount which you have to pay on that particular year uh, transfers from long term liability to short term liability. It is known as current portion of the long term debt. So when we calculate short term ratios, financing ratios, which is also known as liquidity ratios. In that case, we actually gauging the ability of the firm to pay its short-term debt. Okay, there are certain ratios like current ratios, quick ratios, or cash ratios. All these ratios give you an indication that how much ability a company have to pay its short-term debt. It also gives you a picture that what is the symmetry of current assets and current liabilities. But what is the symmetry between the current asset and the current liability of a company? If their maturities are occurring almost on the similar time, there won't be a mismatch. But for instance, if you have mismatch your liability timing, short-term liability timing, and long-term liability timing, means that you don't have liquid assets to pay your liability which is about to due. In that case, or this case can be termed as mismatch of current assets and current liability, which creates the problem of liquidity. So, or you have to manage by taking loan, further loan. So, liquidity ratios deals with the ability of a company to pay its short-term debt, to pay its short-term, or to manage the debt on short-term basis. On the other hand, solvency is a larger domain, or yes, solvency is a bigger issue in a sense that if you are insolvent, it may lead you to bankruptcy. Um, Solvency can also be referred as the ability of the company to pay its long-term debt. So, in solvency, we calculate different types of ratios. Like we are interested in understanding the capital structure of the company. So there are ratios which give you indication about the capital structure of the company. Then we are also interested to know the financial leverage in the company. What is financial leverage? Although we have discussed this point in detail in the campus, but I'm repeating here that leverage is basically, you can say, a support, or we can say it is the element of getting more result by putting less effort. What is this? Is the basic concept of lever in physics as well. Okay, like crane is working on the principle of lever. So in crane, what you do, you put less effort and you get more result. You put less effort and uh, you can drag or you can pull more weight. The same concept is also applied in finance as well. So, leverage refers to the ability of a company that by putting less effort. Now, the effort, what actually here we are calling effort means increasing sale. If you are increasing sale by 5% and you are getting profit, let's suppose increase in the profit by 10%, it means your company has some leverage. Now, how it is possible that by by increasing 5% sale, you are increasing 20% profit or 15% profit or 10% profit. So the reason is, if you have fixed cost in your uh, income statement, it means that that fixed cost will not be increased with the increase of activity. Okay, so if you are increasing sale, your fixed cost remain fixed, and you will be getting leverage effect. Okay, then obviously we will discuss in detail when we will be learning how to calculate these ratios. Okay, gearing and debt servicing. Debt servicing means that repayment of principal amount as well as interest. So these are the aspects and some important concepts in financing ratios. Coming to the cash flow ratios, uh, actually, as we have discussed, that all the accounting process is based on accrual basis of accounting. What is accrual basis of accounting? Accrual basis of accounting means that irrespective of the fact whether you are receiving or paying cash or not, you have to record a transaction if the contract has been done, if that transaction has been occurred. Okay, so in accounting we perform um, accrual basis of accounting, but in finance decisions are made on cash basis. Okay, so when we are performing analysis of financial statements, so a finance manager, even an investor, is also important, that if we translate these accrual based financial ratios or accrual based financial information into cash flow based financial information, and with the help of that cash flow based financial information, we calculate cash flow based financial ratios that will give you some more insight about the company. So cash flow ratios actually covers this aspect. So you can also say that these ratios are uh, nearer to the uh, finance as compared to other ratios, because they are based on cash. Um, Usually, in cash flow ratios, there is no new ratio as such. Although there are few new ratios as well, but in this category, what we are doing, we are converting those accrual basis ratios which we have already calculated into cash basis. For instance, you have calculated operating margin, but that operating margin was based on accrual basis information. Here you convert that operating margin into cash operating margin. It's similarly, you have calculated liquidity through different ratios in financing, and here you calculate liquidity on the basis of cash flows rather than accrual basis, because in accrual basis you consider account receivable inventory as the current asset and as a mean for repayment of that debt. But obviously these current assets, although they are very liquid, but they are not actually cash. So when we are calculating cash based ratios or cash flow ratios, we only consider cash in hand or cash at bank while calculating the liquidity of the company. And similarly, we will calculate investment ratios, and we can also convert those accrual based investment ratios into cash based investment ratios. Then finally, um, we will be discussing we will be discussing investment ratios. As I have said earlier, that for an investor or for external user, these are the most important ratios, or this is the most important set of ratios because it provides you an insight that can we invest in a particular company or not, and is that company is feasible or attractive for investment or not. So these ratios gives a very clear picture about the investment opportunity of in a company. So in these ratios, uh, we will be calculating return on investment, return on asset. We will be calculating earning per share. We will be calculating PE ratio, dividend payout ratio, and yield. So this was the introduction about the categories of the ratios. From next session onward, we will discuss each category into detail, and we will discuss the formulas of calculating specific ratios. Even we will be referring income statement or balance sheet, that from where we can pick information in order to calculate particular ratio. So I hope that this lecture will help you to have an overall view of financial ratios. So, uh, before closing this session, let's have a recap of today's topic. We started with this slide in which we have discussed there are five categories or five groups of financial ratios. Profitability ratios, which provides information about the financial performance of the company. Efficiency or activity ratios, it is also providing us, or these ratios also providing us financial performance of a company. Then we have financing ratios, which gives us a picture about the financial position of the company. In financing ratios, there are two categories: liquidity ratios and solvency ratios. After discussing this, we discussed that there are cash flows ratios as well. Cash flow ratios are not something very new, but these are just the translation of accrual based financial ratios into cash based financial ratios. Finally, we discussed investment ratios. Investment ratios are the ratios in which external users are more interested, because it provides us a very clear insight about the investment opportunity in a company. And after discussing this slide, we have individually discussed each category of the ratios in detail. From next session onward, we will be discussing how to calculate each ratio, that how, let's suppose we will be discussing that how we are going to calculate profitability margins. Okay, so and in order to calculate profitability margins, how to extract figures from income statement. Okay, so we will be starting our new session uh, shortly. And in that session, we are going to discuss the first category of the ratio, which is called profitability ratio. We will discuss how to calculate the profitability margins. Okay, thank you for this session. If you have queries, if you have questions, you can ask me uh, on Google Classroom, as well as we have a WhatsApp group as well. And mind you that I have posted assignment, final project assignment on the Google Classroom. So if those who are watching this video, please go to the Google Classroom. If you have not enrolled in Google Classroom, do enroll. You can call me for how for the Google Classroom code, for asking me the Google Classroom code. And please do join the Google Classroom, because our correspondence about our assignments, submissions, all is can will be done through Google Classroom. Although I have also asked all of you that after completing the assignment, you not only post that assignment on the Google Classroom, but you have to email as well. Okay, but posting of assignment on Google Classroom is also very important. Okay, and you can only get your assignment from Google Classroom. There is no other way that you can get that assignment done. Okay, why I'm saying that, it is because that I have assigned different companies, and I have asked all the students that every student should have a different company. Preferably, the company should be a manufacturing concern, and that company should be in profit for last 5 years. Okay, and company for each student would be different from each other. Okay, I will not accept if two students are performing their project or assignment on the same company. So what would be the process of avoiding that duplication? Is just post the name of the company on Google Classroom. So when you post the name of the company, other student will also see, and they will not select that company. And on the first come first served basis, your that company will be assigned to you. Okay, so this would be the process. Okay, thank you very much, and this is the end of today's lecture or today's session.